Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. And at this juncture, we know that you are probably in the process of doing your taxes. So we want to talk to you about taxes. Um, you're probably, whether you have the documents and you're still talking to your tax preparer, or if it's already done, one of the things that you may have noticed is that oftentimes during this time of year, most CPAs, most tax preparers don't have the time to really talk about the overall strategy of your taxes. They're really just making sure that everything's complete and accurate. We feel that this is a tremendous opportunity for us to fill in the gaps, to bridge the overall tax documents that you have with being able to help provide you with direction and making sure that your taxes are done, your taxes that you experience, your liabilities that you experience are experienced in the most efficient manner. And so our aim is to go beyond the adjustments to withholding or estimated tax payments, but delving more deeper into the strategies, aligning with the broader financial objectives.
Yeah,
Um, we
we,
believe
we
that comprehensive planners can help navigate these complexities, and that's what we want to do.
yeah, we prefer to be proactive in this regard and take certain measures throughout the year to help you and hopefully reduce your tax liability both now and in the future.
Right. So there's things that we are doing without even necessarily talking to you, although we've talked, I'm sure, at one point or another with you, but we're actually doing them all the time. And then there are other things that we probably should have more of a conversation with you about. And so we wanted to actually divide this conversation into the things that we're currently doing and then talk about what else we should be doing and suggest that you should, once you get your 2023 tax return done, that you should send it to us and allow us to review it and even schedule a meeting where we can talk about what we're looking at in 2023 and what we anticipate to happen in 2024 so that we can recommend some suggestions to reduce your tax liability.
And we have access to really good tools to help us project your 2024 taxes and help us identify some strategies that may be pretty useful for you.
That's right.
And
So, uh,
so one strategy we do use on an ongoing basis is what we call asset placement. And that's deciding where a certain type of asset class should be in terms of the taxation of an account. Okay, so for example, natural resources, we tend to prefer to have it in tax deferred accounts, for example, a Roth IRA or a traditional IRA.
because they generate high, not just a capital gains tax when they kick off dividends. Their dividends are not um, they don't have that qualified dividend classification, and so they're taxed at ordinary income taxes. And so
Yep.
that's why we do that.
Yeah, and so you can see we have like a little menu here, and we look at the different asset classes, and we make a decision as to where it should be held. Now, I want to mention something that comes up sometimes in our conversations with you. Sometimes you might say, "Well, gee, why did my IRA grow more quickly than my taxable account, or vice versa?" We know there's going to be some difference because of the way we allocate the asset classes according to the type of account. We do expect in the long run for that to sort of sort itself out. But rather than try to say, all right, let's take your IRA and put it in all 13 asset classes and ignore the tax aspects, we don't do that. We kind of allocate according to this chart. And our software is actually set up to enable us to do this pretty efficiently.
What one thing that I'd like to mention, Steve, is for those clients that we have that don't have, for example, qualified accounts, and we can't
Yeah.
hide anything in those qualified accounts, we do try to provide extra attention to those accounts. So, for example, back in 2022,
Yeah.
when things were so messy, the stock market didn't do well in 2022, a lot of other things didn't do well. Our natural resources did phenomenally well.
Excel.
And we knew that we were going to receive high dividends for the natural resources in December of 2022. So what we did was we actually went into all those taxable accounts and we safeguarded, we actually moved you out of the fund that we knew was going to be paying out the dividend right before they did it.
Yep.
And we went back into it 30 days later when it was safe to go back into it. It's a
Yep.
little bit, it was a little bit of a tedious situation. It's really hard because we have to know exactly their who has this investments in their taxable account and
Yeah.
manage that. But we thought it was worthwhile because we didn't want people to have that tax hit, especially in a year where everything was just not that great.
Yeah. What we were able to do in that case, we were able to do it before they made this income distribution. We sort of turned that potential income distribution into a capital gain instead, which is taxed at a lower rate. The top bracket for ordinary income is 37% right now. And generally, capital gains 15%. You may be as high as 20 and possibly as high as 23.8, but it's still a lot less than 37% if you're in the highest bracket.
And the thing is, I don't even know if clients realize that we did that for them or that we're doing
No.
this type of thing for you. And so we want you to know that we are paying attention to this.
Yep.
Uh, just like how we purchase different exposures to different markets, right?
Yep.
That we can use. A lot of people think that the only reason to use an ETF versus a mutual fund is because they have lower expenses. And while that can be the case, there are other reasons.
That's right. Yeah, and an ETF, which means exchange traded fund, has a very different structure than a mutual fund. So just to explain this simply, an ETF shares are created uh, using a different process, which I'm not going to explain here. But it's whereas a mutual fund, they create their own shares. Whoever issues the mutual fund creates the shares. With an ETF, somebody actually presents a basket of goods to, for example, an S&P 500 ETF, and in return they give them a bunch of shares. Okay, but ETFs are traded on a stock market, and it's liquidity is pretty much just the same as a stock. Whereas a mutual fund, you have to sell it, and the trade or the purchase, actually, the purchase or sale doesn't take place until after 4 p.m. after the market closes. So you don't have liquidity at each moment. So that difference is important from another aspect is that, but while both do pay out dividends, both ETFs and mutual funds, they will pay out all dividends. Capital gains are not realized by the shareholders in an ETF generally until you sell them. Whereas in a mutual fund, internally within the fund, they may have made a lot of trades, sold a lot of stock, and by the end of the year, they have to distribute all those capital gains to the shareholders. And so that's interesting from another standpoint. If you buy a mutual fund, and we will check this. Sometimes you want to check what are the embedded capital gains that you are buying when you buy that fund. So you may buy a fund in argument's sake in October, and it has a lot of embedded capital gains resulting from earlier in the year, or even past years potentially. Suddenly now they make a big distribution in December, and the fund could be down, and you get this big taxable distribution, even though you didn't really gain that much in the fund. So that's a disadvantage of mutual funds. So we tend to prefer generally to use mutual funds more in IRAs and where we can, and also Roth IRAs.
And the ETF universe continues to grow more and
Yes.
more and provide us with more opportunities to find an ETF model to invest you in whatever strategy we're trying to pursue.
Yep. And I wanted to add a caveat we mentioned about the natural resources. That the one we use is actually an ETF, but Laura brought up a good point because of the nature of the way they generate a return. They almost always pay a lot of ordinary income. And so we try to put that, even though it's an ETF, it's not as efficient as a typical ETF. We try to put it in tax deferred accounts.
Well, and one thing that I just thought of as we're talking is that we also went way out of our way to find this particular ETF because
Yeah.
most natural resources exposures are set up in a way that they, instead of distributing money where it comes through a 1099, it comes through K1s, which are a
K1. Yeah.
real pain in the neck when it comes to taxes. And can be very cumbersome. So we're also trying to keep that in mind, finding structures that we can actually work with that makes people's lives easier.
That's correct. Yep. So, okay. I don't think there's anything else here
No.
to talk about.
Yeah, the tax loss harvesting is a big one.
Yep.
And, this is something that we're doing continuously throughout the year, looking at any opportunity to make lemonade out of lemons, where if we did experience a decline, and we know that all of the asset classes are cyclical and have dips. When they
Yep.
have dips, if we can take some of that loss and purchase back a similar investment, we'll try to. And when I say similar, it has to be not the exact investment if we want to have that exposure, because there are rules with the SEC that doesn't allow us to just buy it back within a 30-day period. So we
That's
have
right.
this window of time where if we want to do something like that, we are forced to buy something similar.
And by the way, that doesn't matter if you're capturing a gain. It only matters if you're capturing a loss. They're very happy to have you capture gains.
Right. And there are times somebody might say, why you even mentioning that, Steve? But there are
Yeah.
times where strategically that makes sense. Maybe
Yep.
in a year where somebody had some losses that we can absorb, we want to absorb. Maybe we want to take something off the table and capture the gains, and then
Yep.
repurchase that item right back. Recently, we
Yep.
had one situation with Apple, for example. Somebody had Apple stock,
Yeah.
and we wanted to take the gains off, and then we increased their cost basis by doing that. So now in the future, they won't have as much capital gains.
And additionally, there may be a time when you actually are in a zero capital gains tax bracket temporarily. And then it may make sense to, in effect, sell that asset, repurchase it, and raise your cost basis. And in effect, what you're doing is you're really not going to be taxed on that. And you may end up being in a higher capital gains tax bracket in the future. But guess what? You increase your cost basis, reducing your future tax burden.
And so, Steve, I just want to take what you just said and highlight, this is why we want your tax return. This is why
That's right.
we want to have a conversation with you
Yep.
and do a pro forma tax return for this upcoming year. Because if we don't know that you're currently in a 0% tax bracket, we don't know to take advantage of that. This is really key. So, um, knowing what your tax, and for the clients that we have gone through this exercise, we know what their marginal bracket is. We know
Yep.
what's going on, and so we're able to do a much better job for them. So we
Well,
highly recommend that you have this conversation with us.
it also provides us with indication whether we should buy taxable bonds for you or tax-free bonds in your taxable account, because we need to look at your marginal tax bracket. And I have something on that. There's actually something called a tax equivalent yield. And what we do is we take the current yield of a municipal bond and we divide it by 1 minus your tax rate. And that tells us what the taxable equivalent yield is. So in other words, that tells us whether you should be municipal bonds or not.
Mm. And this is another instance where a lady came to us when we first started
Yep.
working with her. She was in a 37% tax bracket,
Yep.
in which case these municipal bonds made a lot of sense
A
for her.
lot of sense.
And then she wound up, she didn't have that same source of income. She went down to a 22% bracket, and it no longer made sense. We were able, when we
Yeah.
did this comparison of the tax equivalent yield to the yield that we could get in a taxable bond, it wasn't as advantageous. So we wound up switching our strategy on the overall bonds. Again, because we understood and we knew the change in her tax situation.
And when we look at your tax return, when we get a copy of it, of course, we need to gather additional information about you. We know what's happened, for example, in 2023, and it's in your 2023 tax return, but we also need to know what you think is going to happen in this year. And so we really need to know what other income you anticipate other than what we might be aware of, those types of things, so we can do a really accurate projection for the current year.
And the probability of those estimates. So if
Yep.
it's pretty certain, we might make some decisions today. And if it's uncertain, we might say, let's schedule a meeting for September or October when we
Yep.
can make sure that this did happen, and therefore we will make recommendations based on that.
That's correct. Yep. So the other thing too is tax efficient withdrawals. It may make sense to take more money out of your IRA And this is sort of counterintuitive. A lot of people were always taught otherwise. They were always told, don't touch your IRA until you have no choice but to have to pull the money out of your IRA. But it may make sense to take equally from a taxable account and from an IRA. It may make more sense to take most of your money out from your IRA. And the reason is that you may be taxed at a lower bracket than you could possibly tax at when you're forced to take money out of your IRA when you're either 73 or 75.
Well, this happens oftentimes. People don't realize they come to work with us and they have 3 million, $4 million
Yep.
in retirement assets. And they were saying, oh no, we're going to wait till we're 73, 75, whenever
Yeah.
their RMDs are required. And that's when we're going to start taking money out. And if they do that, at that point in time, they're going to have um, a surprise because they didn't realize that it's going to elevate their tax bracket. And not
Yep.
only is it going to elevate their tax bracket, but it probably will affect their Medicare premiums, which is something
Yep.
else that we're trying to keep an eye on. So what Steve's talking about with these withdrawals is that when we start looking at withdrawals, we don't look at it just in terms of 2024. We're now looking at it across the we're more interested in a reduction in overall tax liability throughout your lifetime as opposed to just what's going on in 2024.
Yes. And look, the studies have shown that by being pretty cognizant of what's going to happen in the future regarding your taxes, your money could last a few years longer, by the way, because of that reduced tax burden. So it's nicer to be taxed. You don't want to pay, nobody wants to pay tax, but it may make more sense to pull money out of your IRA and be taxed at a 22% bracket than not touch it. And when you have to take RMDs, suddenly you're in a 37% bracket. And also, like Laura said, you're subject to Medicare increases in Medicare premiums, which could be quite substantial, by the way.
So all the things that we just talked about, Steve, were if we understood what was going on in somebody's overall account and we knew that what their tax bracket was and we knew
Yep.
what was happening that year, we have been making decisions for you regarding withdrawals, regarding whether we're using municipals, regarding whether we're using ETFs and asset placement. All of those are things that we're currently doing, whether you are aware of it or not. But then there are other things that we would love to have a conversation with you about, that they're not things that we can just do to you. We have to do it with you. We have to talk to you
Yeah.
more about it. Um, and, the first one, of course, and it's a big one, is the opportunity to do Roth conversions.
Yep. Yep.
Now, Roth conversions sometimes make sense and they sometimes don't make sense. And so it really does require conversation and looking at your overall cash needs, how much money you have in your IRAs, but you
Yep.
are allowed to, regardless of what your income level is, you are allowed to move money from your tax deferred IRA into a Roth IRA. The only thing is you will pay taxes on that.
Yeah.
So it's almost as if you decide that, you know what, I'm going to hold my nose. I'm going to pay a lot of taxes today. So in the future, I won't have to pay taxes. And one of the times where this really makes especially a lot of sense is when a couple is, there's a big age difference between you.
Hmm.
And
Yeah.
it's anticipated that possibly the older spouse may pass, leaving the younger spouse having to take double the amount of RMDs out, or it's not really double the amount, it's the same amount. The problem is that the tax bracket is now changed. And instead of married filing
Yeah.
jointly, it's single, and it'll change the whole dynamic. So there are times where this really, really makes sense. And there's other times where it might not make that much difference, but we want to have the conversation.
A lot of times you may have a nice window from the time you retire. For argument's sake, you retire early, 63 or 64, and you may decide I'm not going to claim Social Security until I'm 70. Well, that's a nice window right there that where you could potentially benefit from some Roth conversions. Unfortunately, you got to be careful. You're taking Social Security and it's not being taxed fully because you could get hit by what we call a tax torpedo. Whereas by taking extra money out of your IRA, you could actually be in a really high marginal bracket until your Social Security is fully taxed. So it's something we need to look at. It's pretty complex, but we look at it.
Yes, that's something that people miss oftentimes is the taxable portion of Social Security.
Yep,
That
yep,
has to be considered. But Roths are a beautiful thing because
they are.
you're not required to take minimum distributions at any point in time, and in
Yep.
fact can roll them over to your heirs, and your heirs now have this beautiful asset that
Mhm.
is completely tax free. So
Yeah.
it does make sense for the right people.
Yep, it does. Okay.
There's some other strategies as well. One of the strategies that not everybody knows about and that we do talk to people about is the concept of charitable giving strategies. And
Yep.
first of all, you have to be philanthropic in terms of how you want to work with your money. So we're not suggesting that you should do anything with your money charitably unless that's the desire of yours. And if you are, it is a desire, there are ways of using that desire that are more beneficial to you and your taxes.
Yep.
And we have listed here a couple things like charitable remainder
Remainder
trusts and
trust. Yep.
advisor funds. But there's even something when you're taking out RMDs out of your IRAs and you don't want to be taxed, you can also do something called a qualified charitable deduction. And so all of
Yep.
these items are things that we'd like to talk about. I don't, Steve, I don't know how you feel. Sometimes I'm a little bit cautious because I'm afraid to bring up, you know, and ask a client, are you charitably inclined? Because I don't want them to think that I'm passing a judgment. I'm not,
Yeah.
I'm really
Same
not.
here.
But if you let us
Yeah.
know that you are charitably inclined, we absolutely can help you execute that in the best way possible.
Yeah, and CRTs, charitable remainder trusts, are a great strategy if you have a highly appreciated asset. So I think that's just for another video. We're not going to get into the details here, but also there's a couple strategies associated or surrounding estate planning that are important to consider too. So, for example, if one spouse is in poor health and you have an asset that has a law, has is at a loss, it may make sense to transfer that asset to the spouse that is in poor health, because you're gonna and take the loss. You're gonna lose that loss at the person's death, so you can't claim it. Additionally, it may make sense to make sure you split up your account so you get up a step up in basis on the assets that are held by one spouse. So you may want to actually shift more assets to that spouse that's not healthy, because you'll get a step up in basis on those assets. Again, that's just for another video.
um, Yeah, and some of these we're overlapping into the whole estate planning
Yeah,
arena where we might actually even get your attorney involved if that makes sense.
yeah,
One thing that we don't have on this uh, chart, however, that I did want to mention also is this concept that once you retire, people think they should not put any more money away into, maybe you had a 401k in your business. And so you're not putting any more money away into a retirement account. And
yeah,
maybe you should, maybe you shouldn't. The thing is that if you are generating any kind of 1099 income, maybe you're doing a freelance job or some type of thing, you can put money away if you want. And if
yeah,
it makes a difference to what bracket you're going to be in or whether you're going to get hit with a Medicare premium, you might decide to do something like that. So there are times where we will suggest to people, you know what, why don't you have a SEP IRA or even just put money, $6,500 into a traditional IRA or
yep,
Roth IRA. Sometimes it makes sense.
yep. It does, absolutely.
So, as your comprehensive financial planners, we're committed to helping you manage your tax liability and improve tax efficiency, um, of course, to achieve your goals. And since this is tax season, it seems like a perfect time to discuss this with you.
Yep,
We do suggest that once you get your tax return done, that you either upload it to the vaults or you stop by and drop it off and also schedule a meeting with us. It wouldn't be bad to have a portfolio review slash um, tax discussion anyway. So
yep.
please consider that and let us know. Taxes are a very important part of your financial strategy. So let's meet and discuss. It's, after all, your smarter money. Thank you. All
Hmm.
right. So thanks again. And we will hopefully talk to you soon.